keeps swinging from indifference to optimism or pessimism, and from hope to fear. Most people do not follow their own trading plans because they let the crowd influence their feelings, thoughts, and actions. Bulls and bears battle in the market, and the value of your investment sinks or soars depending on the actions of total strangers. You cannot control the markets. You can only decide whether and when to enter or exit trades. Most traders feel jittery when we enter a trade. Their judgment becomes clouded by emotions after they join the market crowd. These crowd-induced emotions make traders deviate from their trading plans and lose money. Charles Mackay, a Scottish barrister, wrote his classic book, Extraordinary Popular Delusions and the Madness of Crowds, in 1841. He described several mass manias, including the tulip mania in Holland in 1634 and the South Seas investment bubble in England in 1720. The tulip craze began as a bull market in tulip bulbs. The long bull market convinced the prosperous Dutch that tulips would continue to appreciate. Many of them abandoned their businesses to grow tulips, trade them, or become tulip brokers. Banks accepted tulips as collateral and speculators profited. Finally, that mania collapsed in waves of panic selling, leaving many people destitute and the nation shocked. Mackay sighed. Men go mad in crowds, and they come back to their senses slowly and one by one. In 1897, Gustave Le Bon, a French philosopher and politician, wrote The Crowd, one of the best books on mass psychology. A trader who reads it today can see his reflection in a century-old mirror. Le Bon wrote that when people gather in a crowd, whoever be the individuals that compose it, however like or unlike be their mode of life, their occupations, their character, or their intelligence, the fact that they have been transformed into a crowd puts them in possession of a sort of collective mind which makes them feel, think, and act in a manner quite different from that in which each individual of them would feel, think, and act were he in a state of isolation. People change when they join crowds. They become more credulous and impulsive, anxiously search for a leader, and react to emotions instead of using their intellect. An individual who becomes involved in a group becomes less capable of thinking for himself. You need to base your trades on a carefully prepared trading plan and not jump in response to price changes. It pays to write down your plan. You need to know exactly under what conditions you will enter and exit a trade. Do not make decisions on the spur of the moment, when you are vulnerable to being sucked into the crowd. You can succeed in trading only when you think and act as an individual. The weakest part of any trading system is the trader himself. Traders fail when they trade without a plan or deviate from their plans. Plans are created by reasoning individuals. Impulsive trades are made by sweaty group members. You have to observe yourself and notice changes in your mental state as you trade. Write down your reasons for entering a trade and the rules for getting out of it, including money management rules. You must not change your plan while you have an open position. Sirens were sea creatures of Greek myths who sang so beautifully that sailors jumped overboard and drowned. When Odysseus wanted to hear the sirens' songs, he ordered his men to tie him to the mast and to put wax in their own ears. Odysseus heard the sirens' songs, but survived because he could not jump. You ensure your survival as a trader when on a clear day you tie yourself to the mast of a trading plan and money management rules. Psychology of trends. Each price is the momentary consensus of value of all market participants. It shows their latest vote on the value of a trading vehicle. Any trader can put in his 2 cents worth by giving an order to buy or to sell or by refusing to trade at the current level. Each bar on a chart reflects the battle between bulls and bears. When bulls feel strongly bullish, they buy more eagerly and push markets up. When bears feel strongly bearish, they sell more actively and push markets down. Each price reflects action or lack of action by all traders in the market. Charts are a window into mass psychology. When you analyze charts, you analyze the behavior of traders. Technical indicators help make this analysis more objective. Technical analysis is applied social psychology. It aims to recognize trends and changes in crowd behavior in order to make intelligent trading decisions. Ask most traders why prices went up, and you are likely to get a stock answer. More buyers than sellers. This is not true. The number of trading instruments, such as stocks or futures, bought and sold in any market is always equal. If you want to buy a contract of Swiss francs, someone has to sell it to you. If you want to sell short a contract of the S&P 500, someone has to buy it from you. The number of stocks bought and sold is equal in the stock market. Furthermore, the number of long and short positions in the futures markets is always equal. Prices move up or down because of changes in the intensity of greed and fear among buyers or sellers. When the trend is up, bulls feel optimistic and do not mind paying a little extra. They buy high because they expect prices to rise even higher. Bears feel tense in an uptrend, and they agree to sell only at a higher price. When greedy and optimistic bulls meet fearful and defensive bears, the market rallies. The stronger their feelings, the sharper the rally. The rally ends only when many bulls lose their enthusiasm. When prices slide, bears feel optimistic and do not quibble about selling short at lower prices. Bulls are fearful and agree to buy only at a discount. As long as bears feel like winners, they continue to sell at lower prices and the downtrend continues. It ends when bears start feeling cautious and refuse to sell at lower prices. Few traders act as purely rational human beings. There is a great deal of emotional activity in the markets. Most market participants act on the principle of monkey see, monkey do. The waves of fear and greed sweep up bulls and bears. Markets rise because of greed among buyers and fear among short sellers. Bulls normally like to buy on the cheap. When they turn very bullish, they become more concerned with not missing the rally than with getting a cheap price. A rally continues as long as bulls are greedy enough to meet sellers' demands. The sharpness of a rally depends on how traders feel. If buyers feel just a little stronger than sellers, the market rises slowly. When they feel much stronger than sellers, the market rises fast. It is the job of a technical analyst to find when buyers are strong and when they start running out of steam. Short sellers feel trapped by rising markets as their profits melt and turn into losses. When short sellers rush to cover, a rally becomes nearly vertical. Fear is a stronger emotion than greed, and rallies driven by short covering are especially sharp. Markets fall because of greed among bears and fear among bulls. Normally, bears prefer to sell short on rallies, but if they expect to make a lot of money on a decline, they don't mind shorting on the way down. Fearful buyers agree to buy only below the market. As long as short sellers are willing to meet those demands and sell at a bid, the decline continues. As bulls' profits melt and turn into losses, they panic and sell at almost any price. They are so eager to get out that they hit the bids under the market. Markets can fall very fast when hit by panic selling.